Hello, everybody, and welcome to our virtual tax school webinar series. My name is Amar Medic, and I am the product marketing manager for TaxWise. We hope that tax season is going well for you this year, and we're excited to have you here. The topic that we'll be covering today is how to maximize Schedule E deductions. Our team will share some tips and tricks on how to get the most out of your clients' returns to help keep your business going strong. Keep in mind that we try to host one webinar per month, so please be sure to join us in the future as well if you find today's session to be informative. With that said, I'm pleased to introduce our speaker for today, Mr. Ryan Hubbs. He's a CPA and solutions architect here at Wolters Kluwer. Ryan has years of experience working in the tax industry and will be sharing his insights on how you can maximize Schedule E deductions for your clients. So with that, let's get started. Ryan, take it away.
Okay, hello everybody, and thank you so much for taking some time out of your busy season. Let's go ahead and get started here. We're going to be going over maximizing our Schedule E deductions. I've hosted quite a few of these tax schools so far, but if you're new, welcome. And if you're a returning member, I really hope to give you some good nuggets of information that's going to really help you out as you come towards the end of busy season here. Just a brief background on myself. My name is Ryan Hubbs. I do have my background in accounting. It's what I went to school for. After I graduated, I moved up to Washington, D.C., worked for 2 CPA firms up there. And living in D.C., I did a little bit of everything. I definitely did a few audits. I worked with the government, a lot of nonprofit work. But for both firms that I worked at, the bread and butter of their business was tax season. And I've probably done thousands upon thousands of tax returns in my life. And in my current role here at Wolters Kluwer, I'm a solution architect. It really means I'm an accountant that is knowledgeable in taxes and tax preparation software. So I love to host these events to make sure that I'm helping out our preparers as much as possible and getting them ready to do their tax returns. Now, here's going to be next a slide of today's objectives. And there's really 5 things that I want to focus on the most. And as you can see by the first point here, I want to identify if a taxpayer is eligible to file a Schedule E. And eligible is a tricky word. I probably should have said required to file a Schedule E, as there's going to be certain criteria set forth by the IRS that's really going to dictate when a Schedule E needs to be filed. And specifically today, we're going to be focusing primarily on rental income, as I think most of the people that you prepare returns for, that's going to be the main use. But we will be going over briefly some of the other uses of the Schedule E and when to use it. We're going to recognize some of the common types of rental properties. You know, a lot of people think that a Schedule E is just for, oh, I have a vacation home and I rent it out, you know, a couple weekends out of the year. That's the only time I'd use it. Not quite so. Really, any type of rental property, if you were not a business and just an individual, that's when you're going to file the Schedule E, and we'll go over some of those different examples for you. And then also we want to go over understanding some of the various deductions. You know, you may be surprised to hear that travel expenses can be deducted from rental properties. And I remember 10 years ago when I just first started doing taxes, I was surprised to hear something like this. I was like, well, what does travel have to do with a rental property? It doesn't seem like those would go hand in hand, but a lot of the times we're going to be treating these rental properties almost as like a business. And there's going to be quite a few deductions that you would not think relate to rental income that will be deductible. We'll also take a deep dive into depreciation. I would say this is one of the more overlooked areas of the deductions that you can get, and really can be rather massive, as homes are expensive and you will be able to deduct that depreciation over the life of the purchase when it was made. Also, we've been going over passive versus active income in regards to real estate. I would guess that most of your clients are going to be passive income, where maybe they just have 1 or 2 houses on the side, they just rent it out. Not really the main activity where they're doing to generate income. But if you are working with any real estate agents, or you are working with any professional developers that maybe specialize in flipping houses, they may be considered active income. And when they are considered active income, the deductions that you're going to take are really going to ramp up. You're going to have a lot more flexibility on that limit to what you can actually deduct. And then lastly, I do want to give you all some practical Schedule E examples using tax preparation software. I have a couple different examples prepared for us today, and time permitting, that'll kind of allow us to get through, 1, 2, or 3, depending on how much time we have here at the end. But I definitely want to start off with the theory of how you actually go about and do this, and then impart some practical knowledge upon you all towards the end of this presentation. So let's go ahead and jump into our first bullet point here and identify who files a Schedule E. Well, as I've said a few times now, if you earn rental income on a home or building that you own, and this can be a few different options. This is not just necessarily your personal residence or a vacation home. It could be even a larger apartment complex, or it could be a duplex. There's a lot of different rental properties that are going to require you to schedule this. And like I was saying earlier, we will be focusing on rental income today, but there are some other uses for the Schedule E, and I just at least want to make you aware of them. Typically supplemental income, this is where it's going to be reported. And I have a friend who used to do taxes for a hip hop artist down in Atlanta, and they'd play his song on Spotify or Pandora or the radio. He would get royalties from his song. And that was also reported on a Schedule E. You also have partnership income, estates, trust, so on and so forth. Typically activities that are generating income for you passively. Once you go and actually create the entity or perform the task, if it's making money for you over time, likely going to go on the Schedule E. Now, I want to go ahead and open this up to our first polling question before we actually go into some of the common rental types. I want to ask you all, do I file a Schedule E if I'm renting a basement or a room in my personal residence? So I'm going to go ahead and put this over to the next slide. You can see we have 3 options: yes, no, not sure. Don't worry if you're not sure, right? This is supposed to be a learning experience. We really want to make sure, we ask these polling questions to make sure that we're giving you content that you all already don't know. I will give you one clarification to this. This is going to be a personal residence that you live at. So maybe you and your spouse and your kids have a few rooms in the house, and then the basement is going out to a completely unrelated person. Would you file a Schedule E to report that rental income? And I'll give you all just about 15, 20 seconds more here, and we will go over the polling results. Okay, just a few more seconds here, and then Amar, whenever you're ready, if you could please go ahead and read us the results.
All right, let me go ahead and close it. It looks like we've got 73% saying yes, 8% saying no, and 20% not sure.
Okay, and it looks like most of you are going to be correct here on the first polling question. This is absolutely an example of when you'd file a Schedule E. Doesn't really matter whether you live there and you rent out a room, or it's just a building completely dedicated to renting to someone else, or even if you have split time. Maybe some of the time you live there and some of the time you rent it out. With Airbnb, that has become much, much more popular. Really, any rental income, as long as you are an individual filing your 1040, is going to go on the Schedule E. And let's go ahead and talk about, some of those different examples of Schedule E clients. As you can see by the first bullet point here, clients at least part of their home, even if it's not a basement. It's just an extra room in your house. Maybe it's a buddy of yours and you just rent it out to help pay off the mortgage. Absolutely Schedule E. I can tell you when I was in college, I had a very, very tiny house that I leased out. I didn't even own it. And I rented out the other 2 rooms to 2 of my friends, and they would pay me, every month some of the rent. And I had to actually go and file that with the IRS and let them know that I did have these 2 people living with me and that I was getting income. And it was part of my taxable income for sure. Next bullet point here, client has moved out of their primary residence with the intent to lease it. I would say by far, this was the most common example that I ran into during my time as a tax accountant. Very, very common for people to go ahead and buy their starter home. Maybe it's a smaller sized house and they start a family, they outgrow it, they want to go ahead and move into something larger that's going to suit their needs. And instead of selling their house, they're actually going to keep it and rent it out and have someone else pay off their mortgage. This is a great way not only to generate wealth long term, but it's also a great way to acquire assets over the course of the life of that home. And then also we want to talk about the client has a vacation home they lease. Think Airbnb. This has definitely been the hot trending topic here, I would say, over the past years. This is going to be a situation typically where there will be some limitations, some calculations we probably need to perform to figure out the deductions. But basically, you're going to take what percentage of the time was the owner going to that house versus how many days was this rented out to somebody on vacation. You're going to take that percentage to really figure out your deductions. We're going to go over that in a bit more detail. And then I also want to point out that it's not just for residential property. It can be for business property as well. If you have a client that maybe owns offices, factories, restaurants, you would absolutely still use the Schedule E. It's a very comprehensive, all-inclusive form. When I was younger going through college, I worked at a beer garden as a bartender. And the owners of that, they didn't own the building that they used. They rented it out from someone else. The person that they rented out from most likely was filing a Schedule E in order to report the income that they were getting. Now, what I want to go ahead and do next is actually bring up my Chrome browser here. And I want to jump into TaxWise Online. And TaxWise Online is going to be the software that we're using to go ahead and show off some of these practical examples. And I have my login saved right here. I'm going to go ahead, put in my user information. We're going to go ahead and log in. And I have a tax return prepared here to kind of go over some of the different forms. Let me go here to the tax returns where they're stored. I have Ashley Allen's return right here. I'm going to go ahead and open this and take a brief gander here just at the main information worksheet. You can see I've entered in just a little bit of basic information. The reason I entered it in here is it's going to flow through into the Schedule E form for us where applicable. And going to go ahead on the left-hand side, and we're going to see Schedule E page 1. We have Ashley's name, or SOCH. Did you make any payments that require 1099? This is typically going to be, independent contractors maybe that you've hired to do some work for you. They're not your employees, but they're working with you on a somewhat consistent basis. And continue to scroll down here. And we actually get to the point where we need to go and list out different rental properties. And you can see that I have two listed here. I have Starfish Lane down in Virginia Beach. That's my hometown. Also have Fox Hollow Avenue. This is going to be in Boca Raton, Florida. And you're going to notice there's going to be some boxes here on the right-hand side that we need to go and fill out. TSJ, taxpayer spouse filing jointly. Ashley is going to be on her own return here, so going to be just the taxpayer. Very important to put the type. And you can see that there's actually the different types are going to be listed up top here. And most of these are going to be in regards to rental income. We have, single family, multifamily, think duplexes, quadplexes, even possibly apartments or condos, but that's probably going to be a little less rare that you're going to run into someone who can actually afford to own one of those larger buildings. Vacation homes, also very, very common. Commercial buildings, think restaurants, factories, offices, etc. Then we also have some of these other items that we were talking about earlier, royalties, other self-rentals. These are going to be more rare, not impossible that you run into it, but probably not quite as much. Moving forward from that, the fair rental days and the personal use days. These are going to be two very important columns for you because this is actually going to give you a calculation on what percentage of the deductions are allowed while filing this form. And we can see for the Starfish Lane, I have this listed as a commercial entity. Typically, these are going to be leased out for the entire year, right? So every single day of the year is going to be a rental day for them. So I went ahead, put 365 in, no personal days. For the Fox Hollow, this is actually a single family residence, as we can see by our codes up top here. And I went ahead and just say they went and rented it out for 1 month. Maybe they went on an extended vacation, used Airbnb or used some other method to go ahead and rent it out. But the vast majority is going to be personal days. This is really their primary residence where they spend their time. Then we have QJV over here. And you may or may not know what QJV is, but if you ever run into a problem, you can always click this arrow right here, go ahead and go to help. And if you go to help, it's actually going to tell you exactly what QJV is. It's a qualified joint venture. And what that really means is qualified joint venture is going to consist of a partnership of partners and spouses who file a joint tax return. And they're both materially participating in the business. They're both, putting in a lot of work to make sure that these rentals are active. Since Ashley over here is just on her own, she is not married, I went ahead and left both these boxes blank. I just wanted to make you aware of the help tools that can be built into the software. Now, what I want to do now is go ahead and dive into a bit more detail into one of these. And we can see, well, I guess I should backtrack. There's going to be a couple ways for you to enter in income and deductions. If we were to scroll down, you're going to see we have our different columns here. We can go ahead and enter in the rents. I went ahead and entered in some of the deductions. And it's typically easiest to do this if we scroll back up on properties where every single day this item was rented. And the reason it's going to be easiest is all of the expenses that are occurred or that have occurred, these are going to be deductible. But what if you run into a situation like this Fox Hollow address where the vast majority of the days are personal use days and only a small amount is for rental income? Well, let's go ahead and link back to a worksheet that I've already completed that's going to show the deductions and kind of the calculations that are occurring. So let's go ahead and link back. We have our rental B worksheet. When we scroll down, you can see starting off very, very similar. We have, the basic information that we just went over. But when we dive down into the actual expenses, we're getting a few more columns down here. We still have our place to add in the rental income, but this 8.33, what is this 8.33? Well, this was an automatic calculation that occurred in TaxWise, letting us know what portion of the rental and personal use is going to be deducted. And the way that this was calculated is actually, if we scroll back up, I'll bring up a calculator here. If we scroll back up, we can see only for 1 month out of the year this was rented. It just simply took the 1 month divided by the total months in the year. That's your 8.3%. And if we scroll back down, we can see the 8.33 being reported right here. And this is going to come into play, this column, rental and personal use, this column all the way on the left. And you're going to need to classify the different expenses that your customers give you. If something is just for rental only, the only purpose of that expense is to add value or fix or maintain your rental business. I'm gonna go in this middle column right here, and this is gonna be fully deductible. You'll be able to deduct every dollar of that. Looks like for this example, I have auto and travel is the main deduction, which we're gonna talk about a little bit more in some greater detail in just a little bit of time. Then I also have a lot of items that are for rental and personal use. What is that? Well, some of these items you'll see here, cleaning and maintenance, insurance. You have to pay insurance every single month. But how are you going to go ahead and calculate that as far as a deduction for a property that's only rented out part of the time? Well, you're just going to take this percentage right here. And I just went ahead and entered in the entire amount. And the software is actually doing the automatic calculation for us. We can actually see if I hover my mouse over the deduction allowed, we get the $83 based off the 1,000 in cleaning and maintenance. If we scroll up, that checks out with the amount that that was calculated right here. And so it's going to be on you really to go ahead and figure out these different classifications. In a perfect world, our clients would go and they would give us all the information just perfectly. They'd split everything up, but usually they just go ahead, write all the expenses. I mean, they want to get their tax return as low as possible, right? It's going to be up to us to really make those judgment calls. And if we're ever not sure, reach back out to them to get that corresponding information to figure out what can be deducted in full and when we're going to need to go ahead and split it up between personal versus rental time. And you can see some of the different items here. If there are repairs made to the house, it is not directly for specifically for the rental income, but it's just general maintenance. You had to get some windows cleaned. You had to go ahead and get something replaced. The oven broke. You may be able to go ahead and just go ahead and deduct both and then just take the calculation. So very, very nice to know the difference between both of those. We will be diving into depreciation in just a little bit here, as I think this is an overlooked item. But before we actually go and do that, let's go ahead and jump back in our PowerPoint. And I want to talk about travel expenses. And as I was kind of alluding to a little earlier in this presentation, when I was first getting started as a tax preparer, I was a little surprised the travel expenses could be deducted from a rental property. The IRS is actually pretty clear on criteria on when you can deduct these. And I've gone ahead and listed out really the two main things. I did throw in a little bonus item, but the two main things that you need to have in order to make these deductions. And first, the primary purpose of the travel must be for the rental property. And I'll give you a quick example here. I have a brother-in-law, he has a ton of different rentals. If he wants to deduct travel to, let's say, Home Depot, he needs to go and get some raw materials, or he needs to get an appliance. If he goes to Home Depot, in order for him to deduct that, that needs to be the primary purpose of the travel. if he had a whole bunch of things that needed to be done for his personal residence, and he just went ahead and bought an oven or an air conditioning unit just on the side, but it was a minor purchase compared to everything else that he was buying. Most of it was for his personal residence, not the rental, not going to be deducted. So I definitely would recommend advising your clients that when they do want to go ahead and maximize these deductions, try to get rental items done at one time and personal items done at the other, or make sure that the primary purpose is for the rental. Make sure the majority of the money that they are spending is in regards to the rental property. Second item that is very important here, and I'd say one that we all probably struggle with, is the clients must keep the receipts to claim the deduction. And this may not be as big an item for you while actually going through and preparing the return. A lot of times they just scribble down what their expenses were. Oh, I had $400 in maintenance or whatever. That might be fine for getting the return done, but this is really to cover yourself when the IRS comes and they do an audit. You want to make sure that you have those copies of those receipts. You want them stored away, really proving that the primary purpose was for the rental property. And then I did throw one more bullet point, not so much because it's a qualification, but I just want to talk about the travel expenses can be a very broad deduction, a very broad subject. Meals are deductible if it supports the business, and there's going to be a few caveats with this. I'll give you the two different examples. Example number one, the client goes, they go to Home Depot, and then they go to Wendy's to get a burger on their way home. That is not going to be considered a travel expense because, that's within their normal course. They're in the same, geographical area where they normally live. What happens if you have a client that is really trying to take their rentals to the next level and they're attending trade shows that are maybe at least out of city, if not out of state? They're going and doing overnight trips to different areas in order to really hone their craft, maybe to get different quotes for specific high-end items. Well, in that case, meals may be deductible if the primary purpose of their travel is to go and further either their knowledge or maximize the value of their little rental company that they have on the side. You can absolutely deduct those meals. So, even though it sounds like rental income, this should be items that we've all heard of: air conditioning units, windows, doors, trimmings, whatever. This is a really broad, encompassing subject, and sometimes I find it easier to think of their rental generating properties as a little side business, and sometimes that can make it a little bit easier to grasp on what can be deducted and what cannot be deducted. And it's very important to note that if you do have a client that is primarily driving, for 2023, it's going to be 65.5 cents is going to be the deduction for transportation. And one of the important things to note about the mileage expenses is if we go back here, this client must keep receipts to claim the deduction. Well, when it actually comes to the mileage, standard's going to be a little bit lower. They're not going to need to show you every receipt that they got from the gas station and then, calculate the average mile of the vehicle. What I'd really recommend them doing is keeping a mileage log. And this can be a fairly simple thing to keep. Most clients aren't going to keep up with this on a daily basis as it's kind of out of sight, out of mind. But if they can just note, okay, I went to Home Depot, 23 times this year, and it was only for rentals. Well, just go ahead and make sure that every time they log, okay, this is time 1, time 2, time 3, etc. And then when it comes to the end of the year, they can actually figure out how long that trip actually took, right? They can go ahead, go to Google Maps, say, okay, this trip is 7 miles, and then you take the 23 trips. And, you kind of work through the math at the back end. But I would really recommend them at least taking some basic steps to make sure that their mileage log is going to be in a pretty reliable state, because at the end of the day, if you do get under audit for any sort of reason, and they want to see the documentation for this, you will at least have a mileage log saying, okay, this is what I was given from the customer. Here's the calculations that occurred. This is, we figured out the distance from point A to point B. And that's really going to be your basis to support the deductions that you are taking. Now, moving forward from this, go ahead and talk about depreciation. I think depreciation is an often unused or misused category for deductions within a Schedule E. I've gone ahead and made a little example here for us. We have a cost basis for the rental at $250,000. We have a cost basis for the land at $20,000, and then we have furniture included in the rental. And I would say furniture being included in a rental is definitely uncommon. I wouldn't say rare, but definitely uncommon. I think most times rentals come unfurnished, but there may be some depreciation items you can take if the furniture is included. And so what I'm going to go ahead and do is let's jump back into TaxWise Online here. And you can see I have a few different worksheets attached to the Schedule E. But let's actually go into Fox Hollow, and we can see, okay, we have the 4562, the depreciation, and we're actually going to drill down one more time down below, get the specific assets for this Fox Hollow address. And what I want to focus on first is I want to focus on depreciating the actual house, the house itself. This example is a primary residence, which you can see I've listed the asset type right here, have the date placed in service. Then I went ahead and attached it to the specific rental activity, which is the Fox Hollow address. And very importantly, I marked it as yes. If this is real estate, is it a residential rental? And this may seem a little redundant, but the reason that we're asking for this is there are two different lives of depreciation based off if it is a residential rental or if it's going to be a business rental. Residential is going to be at 27 and a half years. That's going to be the life of the asset. Business, non-residential really is how I should word it. That is going to be at 39 years. And if we continue to scroll down here, the tax software is really going to be doing most of the work for us. And we can go ahead and see the cost basis of the house. And this is going to match what I have on my slide, $250,000. Now, many people may be tempted to go ahead and try to add in the land value here, but the IRS does not allow you to depreciate land in this situation. Typically, you're going to have to go and remove the two items from one another. And the cost basis typically is going to be what they paid to get ownership of that property. And if we go back into TaxWise Online, we can see some automatic calculations occurring. Keep in mind, we're sticking with the Fox Hollow address that was only rented out for 1 month out of the year. We have our 8.33% here. We can't go and depreciate the full value of the asset because for the majority of this year, it was just a primary residence that would be reported like any house that you own. So we can only deduct the 1 month of depreciation for the Fox Hollow address. And we can see that another automatic calculation occurring down here where even though it's a $250,000 cost basis, that has dropped significantly when it comes to the depreciation that we're going to be able to take for this year. Makers, this is automatically selected as this is, I'd say the most typical method of depreciation when it comes to real estate. And this 27 and a half years, this is automatically populated based off of this question right here. We continue to scroll down, we can see that they're actually getting $757 of depreciation this year, and next year can be the exact same, going to be another $757. What's nice is we really just had to enter in a couple different items, enter in the cost basis, let it know is it residential versus non-residential. The software is doing most of the work for us. You don't have to go by hand and do these complicated tax calculations to try to go and figure out the depreciation. Now, before I go and move on to the next item, I want to go ahead and open this up to another polling question and ask you all, if you have a residential rental that includes furniture, can you depreciate the furniture? Same three options as before, yes, no, not sure. I may have given you a little tip a little bit earlier in this presentation. We'll see if you picked up on it or not, but I'll give you all about 30 to 45 seconds to go ahead and get your answers, and we will go and continue to work through this presentation. Okay, and we'll give you all just a little bit more time here before we start moving forward. Okay, and whenever you're ready to read those results, just let me know.
Okay, I'll go ahead and close it now. We've got about 71% saying yes, 20% saying no, and 10% saying not sure.
Okay, and you all are mostly correct again. The answer is absolutely going to be yes, but that is going to come with some caveats. So let's go ahead and jump back into TaxWise so we can go and kind of walk through depreciation when it comes to the furniture. When we were going and completing this depreciation right here, we are not going to add in the $6,000 into the value of the home. This is furniture and fixtures. So if we were to add in the $6,000 here, it would be taking this depreciable life 27 and a half years, probably using the wrong depreciation method as well. This would be incorrect. So what we'd actually need to go and do is create another asset worksheet, which I've already created down here. And when we click on it, you can see the asset type I selected. I selected furnitures and fixtures specifically for a rental. I have the date the majority of the furniture was placed into service. Same questions as before, but when we scroll down, same thing as before. Only 8.3% of the basis is going to be depreciable. It's going to bring us to $500 using makers, but now instead of a 27 and a half year life, it's just going to be 5 years. Furniture typically depreciates much, much quicker than the actual building itself. And we can see that they're getting about $78. And looks like for next year, there's going to be 55. And if we actually drive back into our Fox Hollow 4562 and we scroll down, oops, I'm on the wrong page here. Let's go to the main worksheet and scroll down here. We can see that it's actually added up both depreciation for the house itself and for the furniture itself at the same time. One more thing to note about this is we are using this 8.33%, so it doesn't have to just be furniture that is for the rental. If it is one of those situations where it's only rented out part of the time, you can definitely take this calculation even if this is the majority used by the family for their personal residence. Now, a couple more things I want to get into before we start going over some practical examples. I want to talk about passive versus active income, and I kind of teased this a little bit earlier in the presentation, but this is a very important delineation that you need to make for your clients. I would guess, and I can definitely say in my personal experience, most rental income that I was reporting was definitely passive. And it's easiest to think about this as smaller scale. This is typically defined as if you use a down payment to acquire a loan and the tenant pays off your loan. This is passive. It's not a great definition though for really making the determination between passive and active. It's much easier to go ahead and figure out if they're active, and that'll let you know. Really, that's like how do I put this? If you can figure out if they're active, that's really going to be the most solid definition of how you need to report it. And active income is going to be money that you trade your time for, like a job. And for example, I work here at Wolters Kluwer. I give them my time as an expert in software and taxes, and they pay me in return. This is definitely active income for you. Well, the IRS very clearly states that active income when it comes to real estate properties is someone that works over 750 hours per year in real estate rental income. And the easiest way, or what would having bells go off in my head, is if I saw someone who's a real estate agent, or if I saw someone who is a developer. Maybe they're buying homes on the cheap, doing a bunch of upgrades, and go ahead and flipping them, trying to make a profit. As long as they're spending 750 hours doing this, this is going to be considered active income. If your clients aren't quite sure on the amount of hours that they've spent working with the real estate, 750 hours is going to be about 20 business weeks. So you can always ask them that question as well. And the reason why it is so important to go ahead and make this delineation between passive versus active, so there's going to be a lot more limitations with passive and actually getting the most deductions possible. If I go ahead and click my next slide here, you can see I took a very, very basic example just to kind of illustrate this point. If something is considered passive and they have a loss, they actually have income of $1,000, they have passive losses of $2,000. Well, even though they've incurred a loss, their net passive income, the lowest it can go will always be zero. You cannot have a negative passive income loss when it comes to real estate. However, if it is active, the active income, same figures here, right? We have $1,000 of income, $2,000 loss. But you can actually report this its full amount at a loss since this is a business generating activity. And you can really potentially make your clients very, very happy with you, because it is not uncommon for your clients to be generating positive cash flows. The money in the bank they ended with is more than the money they started with at the year. But just based off the various legal deductions, you can actually have a net loss, which will reduce the amount that they're going to have to report on their tax return and actually bring that taxable number down lower than it would be otherwise, even though they've had a positive cash gain. So always make sure this is a common question that you're asking people. If you do see a lot of different rental income, if you just saw they had one Airbnb, they've owned it for a few years, very unlikely for them to meet that threshold of 750 hours. But if you see they have 5 or 6, it seems like they're adding more property. There's a lot of capital gains improvements going into them. They're constantly renovating, constantly upgrading. They might be able to hit that threshold, and they might be able to have quite a bit more deductions than if they're just spending a very small amount of time with their rental properties. Now, the next things that I want to go over here before we get into practical examples is I want to talk about a tool that is built into TaxWise Online, and that is going to be the tax book right here. You've probably noticed this on my screen the entire time. Well, a common situation that I would run into is I would have some clients that had inherited rental properties, and they did not keep very accurate figures or really even legible figures for me to go and prepare their tax return. Well, we have something, the tax book, and the tax book, I should backtrack, is kind of like authoritative tax research that can be used to help get these returns done. If you have a specific question about how something should be reported, you can use it. Also going to have a lot of helpful tools within it as well. And I can go ahead and type in rental organizer and click go. It's actually going to bring up the tax book in a separate window within my browser. You can see there's a 2022 individual tax organizer specifically for rental properties. And you can send this back to your clients that are giving you either illegible or incomplete data, and really go and make them fill this out. And what's nice is let me go ahead and bring it up here. It brings up a PDF form that you can send to them, and you can type directly into this PDF. We can actually scroll down to the portion of this that is going to relate to the rental property, and they can just go and type in, okay, this is my Fox Hollow Avenue. This is a single family residence, and really make this all go into a very comprehensive, clearly summarized version for you. You can earn in the fair rental days, so on and so forth. And I've actually gone ahead and completed one of these and sent it back to myself. And you can see that this format, very, very similar to what the tax software itself is going to be. We can see we have property A, property B, property C, what their types are, the days that they were rented, rents received, etc., and all of the deductions down below. And I would usually stress that they should have receipts for these deductions, right? But at least this is a good basis point to start to help you get the returns done. And what I'm going to go ahead and do is jump back into TaxWise Online here, and I'm going to exit out. And I've actually gone and created a blank return. So let's go ahead and open this up. I have my Schedule E blank return. We can go in and maybe do a few examples before we finish out this presentation, just taking some of the theory that we've learned here today and applying it to a real live example. Let me go ahead and open up this return and just have very basic information. There's a lot missing, but for what we need, we really need to go into the Schedule E. So let's go ahead, jump into the Schedule E, and let's scroll down. And let's start off with the item, the third item here. These are exactly the same as we saw before. But what happens if we have the third item here? The location of the property in Austin, Texas. This is a rental. And we can see on this rental that most of the days are fair rental days, about 3 months. And then we have personal use days of just about a year. And I'd say this can be common for rental property, where you're going to see the majority of the time not add up to a full 365 days, because there'll be a lot of days where it is empty. So let's go ahead and jump back into TaxWise Online. I'm actually going to hop into this area right here, and I'm going to link this back to a worksheet. We're going to create, actually, no, I'm going to do it here in box A and link back. Here we are, rental A activities. And let's go through and start entering in some of this information. We have the address 771 East 3rd Street. We'll go ahead and say it's in Austin, Texas. And then we'll go ahead and put the code in as a vacation or rental, code 3. Then let's go back to our organizer that we had our client fill out. Looks like 120 fair rental days and 30 personal use days. Okay, so we're going to do 120. We're going to go ahead and do 30. It's not going to be a qualified joint venture. We can tell based off this time period that 80% of this is going to be deductible. And what were the rents that we received? Let's go ahead, jump back in. We're going to see we have $10,000 in rents. Go ahead, add that in. And then really it's just about going through the organizer and going through the matching receipts and just reporting the different items in the correct column that we talked about earlier. So we'll jump back here. Well, advertising. Advertising, that's definitely going to be full rental use, right? You're not going to advertise for your personal residence. And you can see here in TaxWise, there's not even a space to go ahead and add in advertising, as there's just no scenario where you would ever do it. So let's see, that was going to be $500. Go through, and you're going to notice the full amount is going to be deductible. And this is getting back to what I was saying earlier, how strictly for rental income, or the rental property, I should say, all of that is going to be deductible regardless of this calculation that has been occurring up here. Only for the rental, it's still fully deductible. It doesn't matter how many days you rented out, how many days you lived in it. Go ahead, jump back in. Looks like we have $800 auto and travel, $300 in cleaning and maintenance. Well, let's go ahead and deduct all of the auto and travel. It's probably pretty rare for you to have personal use auto and travel, right? What about the $300 for the cleaning and maintenance? This is definitely going to be joint between personal use and business use, because you're going to have some of those benefits of the cleaning and maintenance, right? In most examples, especially if you're spending up to a month there. You're definitely going to be getting some of the benefits of that cleaning. So we would go ahead and put in the $300 into this, into the rental and personal use, and you can see the automatic calculation occurring. We continue to scroll down, insurance of $1,800. Definitely going to be joint. It's going to be both. Continue here, mortgage fee or management fees, $1,000. This is probably in most scenarios, not necessarily all scenarios, going to be a rental only. So go ahead and put in $1,000. Typically management fees are when you live out of town, you have somebody manage the property, typically at 10% of the income that you receive. And you should definitely deduct that as rental only in most scenarios. Continue to scroll down here, mortgage interest paid to the bank. Looks like right here, $15,000, definitely going to be, not rental only. That is going to be for both, as you have the personal use as well as business use. Doesn't really matter, not really a clear distinction between the two. Go down here, we have repairs, $600. We'll go ahead and add those in. Then we're going to go ahead and add those in as both. Typically you're going to get some of the benefits of those repairs. And then we have taxes and utilities. Both of these can be go ahead and entered in as both, where it's going to be you're getting some benefit as well as the people that you're renting to. We'll go ahead and add in the real estate taxes. Then what were $1,800 in, am I doing this? Yes, in utilities. Now, if we did go and have a few different items of depreciation, we would go about doing this, and I guess we can go add in something very, very quickly. We could go ahead, link back a depreciation worksheet right here. We'll go ahead to 4562, and you can see it's populating directly underneath of this 3rd Street address. And we'll have Schedule E. We're going to say that, okay, this is for the East 3rd Street. We'll go ahead, enter it in. And then typically most of these items on this first page, you can see it's for items that have been recently placed into use, assets placed in service during 2022. You could go through and you can see we have the different lives of the different properties. This is very nice. Summarized view, if it is a new property, is typically that's when you're going to start all the depreciation of the most assets that enter in at one time. But if it is something older, you're actually going to come up to 6A. And if you go to 6A, you can go ahead and create a new worksheet, the asset worksheet, and you can go through and add in any assets that have previously been depreciated in the past. And typically you'll just want to go ahead, we'll go ahead and stick with furniture right here. go ahead and we have a whole bunch of different codes that we can pick from. I'm actually not going to scroll through. I'm just going to go ahead and type in furniture. You can see we have furniture and fixtures rental automatically pop up. Date placed in service, we'll go 01/01 of 2020. And then this is important to attach it. If you have multiple different entities, you want to make sure everything's being attached to the correct place. So we're going to stick with our 3rd Street address. We'll say if this property is real estate, is it residential rental? Yes, it's an Airbnb. It's not an office. It's not a restaurant, so on and so forth. And let's see, do I actually have the cost basis listed here? I do not. I'm going to go ahead and just go and make one up. Austin, Texas, we'll say it's $400,000. And you can see the calculations occurring. Now, we cannot depreciate all of this, unfortunately. I wish we could, so we're going to go ahead, put in 80%. And there we go. We can see the different amounts. We'll do the mid-year, or mid-month, I should say. Automatic calculations occurring. We can see what it's going to be for next year. If we drop back into our rental activities and scroll down, you can see there's the depreciation right there for the place. Moving forward from this, do want to talk about a few other examples that are going to be very common. And I want to give you some visualizations for these examples. So let's go ahead and look at a Form 1098. I would say that this is going to be one of the more common forms that you run into, really for anybody that owns property. And this can be used for a Schedule E. This can also be used just for taxpayers that are paying interest on their personal residence, but we're really going to be focusing how this relates to mortgage interest when it comes to a Schedule E. And typically you're going to enter in this entire amount of the expense right here, this $12,333, and based off the business, the fair rental days versus the personal use days. That's really going to dictate how much is going to be deductible for you when you're completing the tax return. There are going to be some other items to note. The outstanding mortgage principal, less likely that you're going to have to worry about this with a Schedule E, as this is a lot of times more for the buyer's personal information, but should also have the mortgage insurance premiums due. And one thing that I'll run into a lot, and let's go ahead and jump back into the organizer, is I always run into a lot of round numbers, right? I think this is common for all of us if we were to look at mortgage interest. When our clients, a lot of times when they're scribbling down what they're going to go ahead and claim as a deduction, they don't always go into the actual documentation that they're getting. They just remember, oh, I think it was about $13,000. And for certain items, that should probably raise a red flag. It's very, very uncommon for mortgage interest to end in a round number like that, right? Because typically we have a percentage and we're taking that percentage and multiplying it by a round number. So it's very uncommon for it to end with a round number. So you always want to go back and look at the documentation, and we can say, okay, this wasn't $13,000. This was actually $12,333. So always make sure you're cross-referencing and checking to make sure that your clients have not taken the easy path or accidentally claimed a little bit extra. Always want to make sure that you have the documentation to go ahead and make sure that what you as the tax preparer are reporting is accurate. So with all that being said, we do have one more polling question and then some events that we want to make you aware of. So I'm going to go ahead and jump back out of TaxWise and actually ask you all the final polling question here. And would like to ask you all, would you like a more in-depth product demo and further details about TaxWise Online? And the reason that I'm asking this here today is, we do offer TaxWise as one of our solutions. I'd say it's one of our most common solutions, definitely for preparers. And we do like to offer more in-depth product demonstrations that maybe we won't be focusing quite so much on IRS code and how to do each and every deduction, but showing you some of the nice features that are within TaxWise Online. So we definitely want to go ahead, open this up and see if you would be interested in learning a little bit more, or conversely, maybe you're already a TaxWise user. Well, go ahead and let us know. We like to track our engagement metrics here and see how many people are just coming here to learn versus how many people may be interested in new software. and give you all just a little bit of time. And then after this, there are quite a few events that are going to be opened in person throughout the year where me and my team are going to be attending, and we want to make you aware of those. So I'll give you all just a little bit of time to answer this final polling question, and then we will go ahead and talk to you about some of the new events that are going to be occurring this year.
All right, Ryan, I guess I'll go ahead and close it now since we have most of the responses in. So it looks like roughly a little over half the people said they want to hear from us about TaxWise Online. So we'll reach out to those of you who responded yes. So thank you for that. Ryan, before we get into the events, I think there's quite a few questions that people had that while you were presenting. Do you want to just take a look at those real quick and see if you can address some of those?
Let me see here. I typically can see the questions while we do these, but I'm not getting a tab here to see them.
I could read them to you. I just don't know. Under the questions tab, you should be able to see it. But if you want, I can just kind of read it out loud.
Sure, if you want to go ahead and read a few of them here.
Sure.
What we have time.
Laura Sanchez asks, what about if you have a client that has a duplex, lives on one side and rents the other? Is the duplex considered separate properties?
So it's going to be a code that we need to go ahead and put in TaxWise. And getting back to our Schedule E, you can see we have the multifamily residence. And this is going to include duplexes. And typically when going through and doing duplexes, you're going to want to separate the personal use, I guess I'll say residency, from what is actually being rented out to your to the different renters. And so a lot of times there's a few different ways. I'd say most people take the easy route and they just say half and half. Really not technically correct. Really what would be best is to take the square footage of each and figure out the different percentages when going through and doing things like depreciation and things of that nature. Now, it should be noted though, let's say you have furniture in the duplex and this furniture is included. You're not going to have to take the percentage for that. That full amount is going to be depreciable just because that furniture is only being used for rental purposes. So it's kind of a tricky answer where technically it's the same building and some of those expenses will need to be mathematically divvied out from each other, but there will be certain areas where it's going to be a rental only. It's really going to rely on your due diligence and your professional knowledge to make those decisions.
Awesome. We had another question from Susan. Is it required to take depreciation? Does the taxpayer have a choice not to take that deduction? I'm not sure. I guess it came up, but during one of your presentations, so that might be hard to answer.
The answer is you don't have to claim deductions. In fact, the IRS would probably prefer, right, if you don't take the depreciation. But most scenarios, I guess not all, but most scenarios, you probably will want to take the depreciation, but you're not legally required to take a deduction if you don't want to. You could have, even coming down here, you don't have to claim your insurance. You don't have to claim cleaning and maintenance. I'd say for stuff like cleaning and maintenance, a lot of people don't claim it. But the vast majority of the time, you're going to want to take it. But for whatever reason, if you do run into one of those rare situations, by all means, you do not have to take it if you do not want
to. Okay, looks like Laura had a similar question. And then we had Deborah. She is more almost like a statement, but I'll read it. Thought a passive loss for rentals is allowed if your income is under a certain threshold, and the loss up to 25,000 was allowed. This is for passive rentals that have under 750 hours. It's not, I guess, no question there. I don't know if there's anything you want to expound on. And then Tanya had another one. What line should meals be reported? Just report 50% on that line?
For the meals, it can be really dependent on the scenario that you're requiring the meals. Sometimes they will be fully deductible though, right? And I highly recommend when running into situations like that, I can't go over each and every scenario, take advantage of things like the tax book and, go ahead and just type in meals expenses. And that will really spell out when it's going to be a 50% deduction versus a full deduction versus no deduction, right? So, my advice is, since we are limited on time, is just take advantage of the tools that you have available to you, as usually it will spell things out in a pretty black and white scenario.
Awesome. And then the final question that I see from Tanya as well, do fair rental days include when the home is vacant but being worked on? How about if it is vacant for a period of time while the owner was sick and unable to work on the rental, or vacant during the pandemic because the owner is immunocompromised and couldn't risk the exposure?
I would say, to the best of my knowledge, no, that would not be included. Now, I would put a caveat to double check. It's been a while. I've not done this since, COVID and everything, but typically the days that you're renting out the property are the days that you're receiving income. So no.
Awesome. Thank you, Ryan, for being flexible. It's kind of like shooting from the hip when you don't see these questions and me reading them, but I appreciate you doing that. And like you said, we just wanted to share some of the events that we'll be at, if you want to pull up that. So the next one we'll be at, where Ryan's actually presenting, is the Latino Tax Pro National Conference in Las Vegas. Is that July 10th through the 13th, I believe. So yeah, if you guys are planning on attending, let us know by answering below for any of these, really. I know I'll be at the Atlanta IRS Tax Forum, so I would love to meet you guys there if any of you guys are planning to attend. I believe, Ryan, you're going to a lot of these, not just the one in Las Vegas, but yeah.
I think I'll be at most of these besides the New Orleans trip. Yes, I'll probably be at least meeting, greeting, if not presenting.
Awesome. Yeah, we'd love to see you guys there. Take a picture, at our booth. If you're a TaxWise user, make sure you join our loyalty program, TaxWise Insiders. Get rewarded for referring customers and learning more about TaxWise and tax preparation in general. So yeah, we'd love to see you there. Let me see if any more questions came up. So Tanya had one more question. I see. If you choose not to claim depreciation, aren't you still required to reclaim depreciation when you sell the property?
Typically for the business use side of it, this is a common issue that comes up for home offices, I would say, where while if you do have a home office, you can claim the depreciation and the office expenses when you go and sell the property. It's really going to limit the amount of deductions that you have. So if you are running into something like that, yes, it could absolutely be a scenario where you wouldn't want to. I would say for items like rental income, most preparers are claiming that, but that is a very good example of when you might not want to. So, as always, it's up to your professional judgment and taking a long-term look on what's going to be the most beneficial long-term for your clients. But that is absolutely correct. There will be that capture back of, if you do take the depreciation, you will lose out if you do sell the property down the road, for sure.
Awesome. Well, thank you guys for all the questions. Very, very thorough and very thoughtful. We look forward to having you guys at our next event. I think we'll be doing another one next month. So more to come on that. If you've enjoyed this one, please be sure to join us next month as well. And as we'll do this series month by month, we look forward to having you guys. And if you attend any of these events, say hi to us. We'd love to meet you guys. And thank you so much for joining today. And I hope you guys have a wonderful day.
Absolutely. Thank you, everybody.
Bye.